Step number 1, this is going to seem extremely basic, but you have to start with this. Save $2,000. The average American today does not have $1,000 saved up to protect them against an emergency. And the reality is, well, emergencies happen. So I want you to start by saving $2,000 and putting this extra money aside in a bank account to protect you against an emergency. This is not all the money you're going to save. This is the first starting point. You shouldn't be thinking about investing or doing anything else until you have at least $2,000 saved. And during this time, you need to be extremely diligent to not spend money and to work hard to get some extra money that we have this $2,000, because if you don't have $2,000, you are in what I call the financial danger zone. So you should not be eating at restaurants, you should not be going on vacations, and you should not have a Netflix subscription during this time, because you got to get serious about getting your money right. Step number 2 is pay off your credit card debt. So now you have this $2,000 put aside to protect you against an emergency. The next thing you want to do is you want to make sure you never end up in the same financial situation that you were in before. And the way you do that is by paying off your credit card debt. And yes, you're going to do this before you even think about investing. The reason why is because your credit card is charging you 15, 18, 25% a year in interest on your credit card. The average stock market return over the last 50 years has been about 10% a year. So if you're paying 15 to 25% a year on your credit card and you're trying to get 10% a year in the stock market, you have a better rate of return by paying off the credit card debt 1 year early, and it is a guaranteed return because, well, the stock market can go up, but it can also go down. It can also stay the same. If you pay off your credit card debt 1 year early, you have a guaranteed 15, 20, 25% return because, well, that's 1 year that you do not have to pay the interest on your credit card. So when you have these two things, you have credit card debt or you don't have $2,000 saved up, this is the financial danger zone, steps 1 and 2. This is the extreme sacrifice stages. This is going to seem basic for some of you, but this is the extreme sacrifice stages right now. No Netflix, no vacations, no restaurants until you get past these two things. And I get it, it's not fun, but the faster you can get away from this, the faster you can start building wealth. And the reality is when you get stuck here, you're constantly working hard to make somebody else rich. The reason why all these banks have these huge high towers and these private jets is because you're paying them that 18, 20, 25% interest on their investments. Stop doing that. Get that credit card debt paid off. That way you never have to do it again. Step number 3 is you need to create a system for your money. Now that you have laid this base, now that you have a financial foundation, you have no more credit card debt, you have some extra savings put aside, now you need a system that way you know how much money you can spend, how much money you can save, how much money you need to invest every time you get paid. And a simple rule of thumb that I like to teach is 75, 15, 10, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum you invest. 10 cents is the minimum you save. This way, whether you make $10,000, $100,000, or $10 million, you're always saving and investing your money before you spend your money. This way, you're putting money aside to make yourself wealthy before you make everybody else rich. And when I say this, the first time people hear it, it's going to feel a little weird because, Jaspreet, I'm already struggling to pay my bills as it is. How do you expect me to live off of 3/4 of every dollar that I earn? And the way that I want you to think about this is if the government was to raise your taxes tomorrow by 25%, what would you do? You'd probably complain and cry and kick and scream and be upset and angry, and then you're going to find a way to pay it. Because if you don't, you're going to end up in jail. Think of it like a tax. But this time, your tax isn't going to make the government richer. Your tax is to make yourself richer. If you spend every dollar that you earn, you are never going to build wealth for yourself because the way that you become wealthy is by investing your money, period. And you can only invest your money if you put money aside to invest, which means you have to earn money and not spend it and then invest it. But if you're constantly making money and spending all of it, you're making everybody else rich. You're making BMW rich, you're making Gucci rich, you're making your landlord rich, you're making your mortgage company rich, but you're not making yourself rich. So if you want to make yourself rich, you have to not spend all of your money. It is difficult in the beginning, but once you do it, you'll start to see, oh, yeah, it takes some lifestyle adjustments, and then you realize you are never going to spend all the money you earn again, and once you get into that mindset, it becomes a habit. 75, 15, 10 is a place for you to start. Create 3 different bank accounts. 1 bank account to hold your savings money, 1 bank account to hold your investment money, 1 bank account to hold your spending money. You need the 3 different bank accounts. That way you have walls between your money, that way you do not accidentally spend your investment money or your savings money. But this is how you now start to amplify your wealth, and this is where things start to get fun. So let's talk about number 4. Step number 4 is start investing your money. Remember, this savings money is just going to sit there. It's not going to do anything. This spending money is where you're going to buy your house, your car, your groceries, your vacations, and all that other stuff. But what about this money right here that's sitting there waiting to be invested? And this is where there's a couple different investing strategies that I want to go over that let's talk about. The first question that I want you to think about is, are you an active investor or are you a passive investor? And an active investor, I'm not talking about trading. An active investor is somebody who wants to manage their investments themselves. So in the stock market, this is when you're going out and investing in individual companies. You're researching Tesla, you're researching Amazon, you're researching McDonald's, and you want to see, are their financials making sense? Is this an undervalued company, an overvalued company? In the real estate game, this is where you're actually going out and you're finding rental properties, single family houses, apartments, office buildings, commercial buildings, and you're going out and buying them yourself. You're not actually managing it. You're still going to hand the keys over to a property manager, but you're going out and you're finding those individual deals. Passive investing is when somebody else is going to manage the investment for you. So in the stock market, instead of you investing in Amazon or Tesla or McDonald's, you're going to invest into a fund. Something like, say, the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Now, instead of you going out and investing in an individual company, you're just going to invest into a fund that's going to give you exposure to the United States stock market, or the largest 500 companies, or healthcare stocks, or real estate stocks, or AI stocks. So you're just passively investing your money into a basket of stocks because now this fund is managed by somebody else, it's managed by a fund manager. Or in real estate, instead of you going out and finding a rental property yourself, you're going to invest into somebody else's fund. This could be a syndicate deal. This could be a crowdfunded deal where now you're going to invest in somebody else's deal and then they're going to do the work. They're going to manage the property. You're going to get your share of dividends. This passive investing comes with less risk. It comes with less work, but also generally less potential reward. The key here is potential, because sometimes you can make an active investment, which is more risk, for more potential reward, but you can also be wrong, so you can lose that money as well. So less risk, less potential reward, more risk, more potential reward, more time as well. And you don't have to pick one or the other. What I do is I have a mix of both. I have active investments and I have passive investments. I invest into real estate actively. I do have some passive real estate investments, but the bulk, like 90% of my real estate portfolio is active investments. With my stock market portfolio, I have about half in my active investments and about half in my passive investments. So you can kind of find a balance for you, but you have to know what type of investor you want to be. Before I get into the second question that I want you to ask yourself, I want to remind you that for those of you that are investors or want to become investors, I have put together a brand new free investing masterclass where I'll walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll even lay out the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It is a completely free masterclass. There's a ton of value in this masterclass. So if you want to watch the Investing Masterclass for free, all you have to do is register. I have the link for you down in the description below. And when you register, you're also, as a bonus, going to get access to Market Briefs, which is my newsletter for investors, completely free. The second question I want you to ask here is, do you want to invest for growth or do you want to invest for cash flow? Investing for growth is you invest your money into a stock, $100 today, hoping that it's going to be worth $200 in the future. Or do you want to invest for cash flow, which is I'm going to invest this $100 today and then I'm going to make a few dollars back in cash flow every year without having to sell my investment. Now, some of you are going to like cash flow, some are going to like growth. Both are great. You have to find what's right for you. When you're investing for cash flow, you also have to think about taxes, because as soon as a company pays you a profit, a dividend, or a rental property pays you a profit, which is your rental income, you have to pay taxes on that income. Now, generally, there are ways to pay less taxes on this money, like dividend income generally qualifies for lower tax rates. Your rental income has a lot of potential tax deductions as well. But you have to think about the tax game now as you start generating the cash flow as well. With growth, you have to think about what happens when it comes time for me to sell and it's a recession, because the value of an investment is ultimately worth what somebody else is willing to pay for it. And today that investment might be worth $100. Tomorrow it could be $200, but it could also be $50 depending on what's happening in the economy and shifts that can happen as well. So not one is right or wrong, you have to decide what's right for you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.